So let us go in detail related to sources of finance. A business can raise funds from various sources. Each of the source has unique features which must be properly understood so that the best available source of raising funds can be identified. So there is not a single best source of funds for all organizations. Depending on the situation, purpose, cost, and associated risk, a choice may be made about the source to be used. For example, if a business wants to raise funds for meeting fixed capital requirements, long-term funds may be required, which can be raised in the form of own funds or borrowed funds. Similarly, if the purpose is to meet the day-to-day requirements of business, the short-term sources may be tapped. A brief description of various sources along with their advantages, let us discuss. First one is retained earnings. A company generally does not distribute all its earnings amongst the shareholders as dividends. A portion of the net earnings may be retained in the business for use in the future. This is known as retained earnings. So it is a source of internal financing or self-financing. The profit available for self-financing in an organization depends on many factors like its net profits, dividend policy, and age of the organization. The main benefits of this source is it's a permanent source of funds available to an organization. It does not involve any explicit cost in the form of interest, dividend, or flotation cost. As the funds are generated internally, there is a greater degree of operational freedom and flexibility. Even it enhances the capacity of the business to absorb unexpected losses. Even it may lead to increase in the market price of the equity shares of a company. The limitations of this source is it is an uncertain source of funds as the profits of business are fluctuating. If the company has a profit, yes, you can retain a part of profit as a sources of funds. If you are under loss, you are not going to have this type of sources of funds in the business. Next comes trade credit. See, trade credit is a credit extended by one trader to another for the purchase of goods and services. Trade credit facilitate the purchase of supplies without immediate payment. So such credit appears in the records of the buyer of goods as sundry creditors or account payable. Trade credit is commonly used by business organizations as a source of short-term financing. It is granted to those customers who have reasonable amount of financial standing and goodwill. The volume of and period of credit extended depends on factors like reputation of the purchasing firm, financial position of the seller, and the volume of purchases, past record of payment, and degree of competition in the market. So terms of trade credit may vary from one industry to another and from one person to another. A firm may also offer different credit terms to different customers. The important advantages of this is it's convenient and continuous source of funds. So it may be readily available in case the credit worthiness of the customer is known to the seller, and it promotes the sales of an organization. If an organization wants to increase its inventory level in order to meet expected rise in the sales value in the near future, it may use trade credit to finance the sale. Main disadvantages of this source is availability of easy and flexible trade credit facilities uh, may induce a firm to indulge in over trading, which may add to the risk of the firm, and only limited amount of funds can be generated through trade credit. It is generally a costly source of funds as compared to most other sources of raising money. Next type we have is factoring. See, factoring is a financial service under which the factor renders various services like discounting of bills. Usually the bank is going to act or providing these type of services, and collection of clients' debt. So under this, the receivables on account of sale of goods or services are sold to the factor at a certain discount. The factor becomes responsible for all credit control and debt collection from the buyer and provides protection against any bad debt losses to the firm. So there are two methods of factoring actually, recourse and non-recourse. Recourse means the client is not protected against the risk of bad debts. On the other hand, the factor assumes the entire credit risk under non-recourse factoring. That is, full amount of invoice is paid to the client in the event of the debt becoming bad. Providing information about credit worthiness of prospective clients, etc. So factors hold large amounts of information about the trading histories of the firms. So this can be valuable to those who are using factoring services and can thereby avoid doing business with customers having poor payment record. The factor charges fees for the services rendered. So factoring appeared on the Indian financial scene only in the early 90s as a result of RBI initiatives. The organizations like SBI, Commercial Services Limited, Can Bank Factors Limited, Foremost Factors Limited, State Bank of India, Canara Bank, Punjab National Bank are acting as a factors. The main merits of this factoring sources of finance is obtaining funds through factoring is cheaper and cash flow accelerated by factoring. Client is able to meet his liabilities promptly, and it is as a source of funds, it is flexible and ensures definite pattern of the cash inflows from credit sales. It does not create any charge on the assets of the firm. The client can concentrate on other functional areas of business as the responsibility of credit control is shouldered by the factor. The main limitation is that this source is very expensive and it includes various invoices um, in smaller amounts. So the advance finance provided by the factor firm is generally available at a higher interest cost than the usual rate of interest. And the factor is a third party to the customer who may not feel comfortable while dealing with it. Next comes lease financing. A lease is a contractual agreement whereby one party, that is the owner of an asset, grants the other party the right to use the asset in return for a periodic payment. So there is a two parties involved, lessor and lessee. The lessor is the owner of the asset and lessee is a user of the asset. So lessor transfers the goods to the lessee for the use. Against this is going to collect a charge or fees that is called as rentals. So benefits of this source is it enables the lessee to acquire the asset with a lower investment, and simple documentation make it easier to finance assets. Lease rentals paid by the lessee are deductible from computing taxable profits. Even it provides finance without diluting the ownership or control of assets. Limitations of this is a lease arrangement may impose certain restrictions on the use of assets. For example, it may not allow the lessee to make any alteration or modification in the asset. The normal business operates may be affected in the case lease is not renewed. It may result in higher payout obligation in case the equipment is not found useful and the lessee opts for a premature termination of the lease agreement. Next comes public deposits. The deposits that are raised by organization directly from the public are known as public deposits. The rates of interest offered on public deposits are usually higher than that offered on bank deposits. So any person who is interested in depositing money in an organization can do so by filling up a prescribed form. The organization in return issues a deposit receipt as acknowledgement of the debt. Public deposits can take care of both medium and short-term financial requirements of a business. The deposits are beneficial to both the depositor as well as to the organization. While the depositor get higher interest rate than that offered by banks, the cost of deposits to the company is less than the cost of borrowings from banks. Companies generally invite public deposits for a period up to 3 years. So the acceptance of public deposits is regulated by the RBI. Main merits of this is the procedure of obtaining deposit is simple and it does not contain restrictive conditions as are generally there in loan agreement, and cost of public deposit is generally lower than the cost of borrowings from banks and financial institutions. Public deposits do not usually create any charge on the assets of the company. The assets can be used as security for raising loans from other sources. As the depositors do not have voting rights, the control of the company is not diluted. The limitations of this is companies generally find it difficult to raise funds through public deposits. It is an unreliable source of finance as the public may not respond when the company needs money. Next comes commercial paper. Say it is an unrecorded money. It is an unsecured money market instrument issued in the form of a promissory note. See, first time introduced in India is in the year 1990. It enables the corporate borrowers to diversify their sources of short-term borrowings and to provide an additional instrument to investors. So subsequently, primary dealers and all Indian financial institutions were also permitted to issue commercial paper to enable them to meet their short-term funding requirements for their operations. Individuals, banking companies, other corporate bodies, unincorporated bodies, non-resident Indians, and foreign institutional investors can invest in commercial papers. And it is issued for maturities between 7 days, minimum of 7 days, and a maximum up to 1 year from the date of issue in denominations of rupees 5 lakh or multiples thereof, means 5 lakh, 10 lakh, 15, 20 lakh. However, the maturity date of the commercial paper should not go beyond the date up to which the credit rating of the issuer is valid. The merits of this is a commercial paper is sold on an unsecured basis and does not contain any restrictive conditions, and it is a freely transferable instrument. It has high liquidity. It provides continuous sources of funds for the business. The limitations of this is only financially sound and highly rated firms can raise money through commercial papers. So, which is having a moderate rate, they may find it difficult to raise finance by issuing commercial papers because public are not going to prefer to invest in such companies. Even the size of the money that can be raised through commercial paper is limited to the excess liquidity available with the suppliers of funds at a particular time. So next comes issue of shares. See, the capital obtained by issue of shares is known as share capital. The capital of a company is divided into small units called shares. So each share has its nominal value. So for example, a company can issue 1 lakh shares of rupees 10 each for a total value of rupees 10 lakh. The person holding the share is known as shareholder. So there are two types of shares normally issued by a company. These are equity and preference shares. Shares is called the money raised by issue of equity share is called equity share capital, while the money raised by issuing preference shares is called as preference share capital. Equity shares. Equity shares is the most important source of raising long-term capital by a company. So equity shares represents the ownership of a company, and thus the capital raised by issue of such shares is known as ownership capital or owners funds. Equity share capital is a requisite to the creation of a company. Equity shareholders do not get a fixed dividend but are paid on the basis of earnings by the company. They are referred to as residual owners since they receive what is left after all other claims on the company's income and assets have been settled. They enjoy the reward as well as bear the risk of ownership. Their liability however, is limited to the extent of capital contributed by them in the company. Additionally, through their right to vote, these shareholders have a right to participate in the management of the company. The important merits of raising funds through equity share is equity share are suitable for investors who are willing to assume risk for higher returns, and payment of dividend to the equity shareholders is not compulsory. Therefore, there is no burden on the company in this respect. So equity capital serves as permanent capital as it is to be repaid only at the time of liquidation of the company. Equity capital provides credit worthiness to the company and confidence to prospective loan providers. Main limitations of this source is investors who want steady income through their equity shares, as the income on equity shares. The cost of equity share is generally more as compared to the cost of raising funds from other sources. The issue of additional equity shares dilutes the voting power and earnings of existing equity share holders. Next comes preference. The capital is by issue of preference share is called preferential capital. The preference shareholders enjoy a preferential position over equity shareholders in two ways: receiving a fixed rate of dividend out of the net profits of the company before any dividend is declared to equity shareholders, and receiving their capital after the company's securities have been settled at the time of liquidation. In other words, as compared to the equity shareholders, the preferred shareholders have preferential pay over dividends attributable to the capital. Preferred shares pay a fixed rate of also as the dividend is payable only at the discretion of the directors and only of the profit after tax through shares. The maximum is resembled to shares. Thus, different shares have some characteristics of both equity shares and debentures. The advantage of this source is different shares provide easily very steady income in the form of fixed rate of return and safety investment. And it is useful for those investors who want fixed rate of return with comparatively low risk. And it does not affect the control of equity shareholders over the management as well as shareholders don't have voting rights. Payment of fixed rate of dividend to preferred shares may enable a company to declare higher rates of dividend. The limitations is it is not suitable for those investors who are willing to take risk and invest in higher returns. Difference capital dilutes the range of equity shareholders over assets of the company. The rates of dividend on preferred shares is generally higher than when rates on debentures. Some debentures. So debentures are an important instruments for raising long-term capital. A company can raise funds through issue of debentures, which bear a fixed rate of interest. The debenture issued by a company is an acknowledgement that the company has borrowed a certain amount of money, which it promises to repay at a future period. Besides, debenture holders are therefore down as creditors of the company. Debenture holders are paid a fixed stated amount of interest at prescribed intervals like 6 months or 1 year. Public issue of debentures requires that the issue be rated by a credit rating agency like CRISIL, that is Credit Rating and Information Services of India Limited, on aspects like a track record of the company, its profitability, debt service capacity, credit worthiness, and the perceived risk of lending. A company can issue different types of debentures, they can issue zero interest debentures, which do not carry any explicit rate of interest, has also become popular in recent years. The difference between the face value of a debenture and its purchase price is a return to the investors. Merits of raising funds through debentures are: it is preferred by investors who want fixed income, who want fixed income at lesser risk. Debentures are fixed charge funds and do not participate in profits of the company. Therefore, there will be more profits available to the shareholders to declare as dividend. The issue of debenture is suitable in the situation where the sales and earnings are relatively stable. The disadvantages of this is, as fixed charge instruments, debentures put a permanent burden on the earnings of the company. There is a greater risk when earnings of the company fluctuate. Next comes commercial banks. I hope all knows related to this, as it is occupied a vital position as they provide funds for different purposes as well as for different time periods. Banks extend loans to firms of all sizes and in many ways, like cash credits, overdrafts, term loans, purchase, discounting of bills, and issue of letter of credit. The rate of interest charged by banks depends on various factors such as the characteristics of the firm and the level of interest rates in the economy. So the main merits of raising funds from the commercial banks are: bank provide timely assistance to business by providing funds as and when needed by it. Secrecy of business can be maintained as the information supplied to the bank by the borrowers is kept confidential. Formalities such as issue of prospectus and underwriting are not required for raising loans from a bank. So it will be easier to raise the funds. Loan from a bank is a flexible source of finance as the loan amount can be increased according to business needs and can be repaid in advance when funds are not needed. Limitations. Funds are generally available for short period and its extension or renewal is uncertain and fleeting. Banks make detailed investigation of the company's affairs, financial structure, etc., and may also ask for security of assets and personal security, surety. This makes the procedure of obtaining funds likely difficult. Next comes financial institutions. The government has established a number of financial institutions all over the country to provide finance to business organization. So these institutions are established by the central as well as state government. They provide both loan capital and loan capital for long supplement. The traditional financial agencies like commercial bank, as these institutions aim at promoting the industrial development of the country. There are also called development banks. In addition to providing financial investment, these institutions also conduct market surveys and provide technical assistance and managerial services to provide financial assistance. These institutions also conduct market surveys and provide technical assistance and managerial services to people who run their enterprises. So this source of financing is considered suitable when considered suitable when large funds for larger duration are required for expansion, reorganization, and organization of the enterprise. Next comes international financing. In addition to the sources discussed above, there are various avenues for organization to raise funds internationally. The opening up of an economy and the operations of business organizations becoming the global Indian companies and then ancestral funds in the capital market. Various international sources from where funds can be generated, commercial banks, international agencies and development bank, international capital market, the global depository receipts, American depository receipt, Indian depository receipt, etc. So in the next class in detail is to be institutional investors. Thank you.